Hello and welcome to the weekly market metrics. I'm your host Sandeep and we are in week 11 of 2026. It's mid-March, the Nifty is down 11% from its all-time high. Not just that, this week Nifty fell close to 5% and that's the single biggest weekly fall since June 2022, and that's after 3 years and 9 months. Last week, given all the geopolitical tensions, I had said that the markets were appearing relatively calm. This week, the fear started showing up. The effect of the tensions in West Asia are being felt closer home now. These are difficult times for us and for the world at large. As much as I hate to say it, given the human toll in such times, financially speaking, these are also times where you see opportunities in the markets both as an investor and a trader. Anyway, let's get started and look at the charts and see how the price action unfolded this week. And as always, we'll also look at what's possible in the coming week. As always, let's start with Nifty. On a weekly time frame, Nifty lost 5.31% or 1299 points this week to close at 23,151. Yes, 23,151. Let that sink in. This was the biggest weekly fall in 3 years, 8 months and 24 days to be precise. The last time we saw a bigger weekly decline was in the week of 13 June 22 when index fell 5.61%. Now talking about supports and resistances, well, the immediate resistance is placed at 23,200 followed by 23,900, 24,000 zone. On the downside, support is seen at 22,900 and then near 21,750. The bias for the coming week remains bearish with the possibility of occasional pullbacks which are likely to be sold into. Given that this week was anything but a normal week, I did some quick analysis. I took all the Nifty data since its inception, which is 35 years of data, to run a simple test. Every time when Nifty closes greater than 10%, what happens to the index in the subsequent quarter, 6 months and a year? You see, 74% of times it's higher a year later with a median return of 10.2%. That's some solace in these times, isn't it? Anyways, moving on to the daily time frame. Well, Nifty moved minus 1.73% on Monday, positive 9.7% on Tuesday, again negative minus 1.63% on Wednesday, and then again a negative 0.95% on Thursday, and minus 2.6% on Friday. That makes 4 red days and just 1 green day for the week. As mentioned earlier, pullbacks during a downtrend can often be sharp, making it feel like the worst is over. But unless we start seeing closes above recent swing highs, the price action begins to form higher highs and higher lows. It's difficult to say that the trend has changed. This also reminds me of something Rob Hanna mentioned in the recent podcast on the channel. Pullbacks in a downtrend are usually weaker than pullbacks in an uptrend. The full episode goes out live on Sunday, so do watch it. It's packed with such nuggets. Coming back to Nifty on a daily time frame, supports are placed at 22,900 followed by 22,300. On the upside, resistance lies at 23,200 and then 23,550 and then 23,850 zone. On the 1 hour time frame, I had mentioned last week that Nifty spent the entire week below the 50 EMA and that short-term trend followers could start seeing some MTM gains if the trend continued. This week, that weak structure remained firmly in place. Nifty stayed comfortably below the 50 EMA throughout the week. Even the Tuesday pullback couldn't sustain, and the down move quickly resumed. After a long time, trend followers seem to have a proper trend to work with. And that's often how trend following works. Many small losses that are eventually made up by that one big win. Okay, let me not jinx it because you never know how long it lasts or how many points would this downtrend capture. Moving on to Nifty's expected range till the upcoming weekly expiry, Nifty's 1DT ATM Straddle premium close to 500 points, up 72 points from last week. With so much uncertainty going around on the US-Israel-Iran conflict, this was somewhat expected. This currently implies that a 2.15% move is possible on either side of Nifty spot price. Based on the current straddle pricing, the expected range till expiry is 23,650 on the upside and 22,650 on the downside. That's roughly a 1,000-point range for Nifty. Looking at the upcoming Nifty weekly expiry open interest, on the put side, 23,000 put, 22,500 put and 22,800 put stand out with the highest open interest going into the weekend. On the call side, 23,500, 23,600 and 23,700 strikes have relatively higher open interest. Interestingly, put open interest is higher than call open interest at the moment. But given how quickly index has been moving, any sharp move can change these numbers very fast. For now, it broadly tells us where the market participants have positioned themselves, with 23,000 on the downside and 23,500 to 23,700 zone on the upside. Moving on to SENSEX, well, on the weekly time frame, SENSEX lost 4,355 points. Yes, a whopping 4,355 points or 5.52% for the week to close at 74,563. The inverted hammer candle from last week did not see any upside follow through, and instead, the index continued to move much lower. Immediate resistance is placed at 75,500, followed by 77,000 and then 78,800. On the downside, support is seen near 71,400. The view for the coming week remains bearish, with occasional pullbacks that are unlikely to change the broader trend of the index. Moving on to the daily time frame, supports are seen at 73,400, followed by 71,450, which is the low made during the Trump tariff announcement back in April 2025. On the upside, resistance are placed at 75,600, 76,750 and 78,550. Talking about SENSEX range till expiry, the next SENSEX weekly expiry is on 19th March, Thursday. The ATM straddle closed at 2,078 points, up from 1,800 points last week. This implies roughly a 2.79% move on either side from where the spot is right now. Based on this pricing, the implied expiry range on the upside is at 76,642 and on the downside it's 72,486. This broadly places SENSEX in the range of 76,650 to 72,500 going into this expiry. Talking about Bank Nifty, on the daily time frame, Bank Nifty is again sitting right at an important support of 53,600. And below that is the next support, and it's around 52,000 level. On the upside, resistance lies at 55,600, followed by 56,950 and 57,700. For the week, Bank Nifty lost 4,025 points or 6.97%, marking the largest weekly fall since 18th May 2020. That's 5 years, 9 months and 19 days for you. The weekly range was 3,421 points or 6.37%, reflecting the kind of volatility the index saw. The index is clearly in a bearish territory, and in such conditions, I would rather follow the trend than take contra bets on the upside. Don't do that, it seldom works. On the hourly time frame, price continues to remain below the 50 MA, and the trend from the last week has largely continued. In fact, this is turning out to be one of the biggest single trades in many years for short-term trend followers on Bank Nifty. But moves on the downside are often less enjoyable because while trading positions may be making money, the portfolio itself is bleeding. So net-net, it often feels like a break-even, with trading profits compensating for notional losses in the portfolio. But that's not bad either. Moving on to rate of change, in week 11, the red only got deeper and darker across indexes. Bank Nifty lost close to 7%, SENSEX about 5.5%, Nifty 5.3% and mid-cap Nifty around 4.2% for the week. On a YTD basis, the numbers are firmly in red as well. SENSEX is down about 12.5%, Nifty around 11.4% and Bank Nifty close to 10%. At this pace, it looks like all 3 months of 2026 so far, Jan, Feb and March, may end in red. Talking about the sectors this week, as expected, not a single sector was positive this week. The most resilient ones are all carried forward from the last week. Pharma is at the top, with energy next and then CPSC, PSC and IT. That's pretty much about the sectors. Talking about range and expiries, well, Nifty's average daily range expanded further this week to 345 points, up from 325 points last week, showing that volatility continues to remain elevated. Wednesday saw the widest range at 465 points, while Monday and Friday were almost similar, both close to 380 points. Moves and ranges of around 1% have become quite common over the past couple of weeks. But such wide ranges also create many trading opportunities, provided one keeps position sizing in check. Periods like these are where trend following and volatility-based strategies tend to shine. Let's talk about Nifty's weekly expiry, which is on 10th of March, Tuesday. After a 279 point or 1.17% gap up on Tuesday, Nifty quickly saw selling pressure with the index falling 0.92% from the top within the first 45 minutes. From there, it recovered nearly 0.9% and closed the day at 24,261, which was up 0.97% from the previous day's close. Apart from the initial volatility, the day was relatively manageable for straddle and strangle sellers, with the at-the-money straddle opening at around 202. By the way, the overnight crush that we've been seeing over the past couple of weeks has been quite substantial. On expiry day, the overnight premium decay in straddle was close to 150 points, which shows the kind of risk premium option writers are demanding to carry positions overnight. Moving on to SENSEX weekly expiry, which was on 12th March, Thursday, with a 0.64% gap down opening, SENSEX saw wild swings throughout the expiry day. The index rose 0.93% till around 11 am and then fell 0.55% till about 1 pm, followed by another 0.7% up move till 1:40 pm, then finally dropped nearly 1% from there till 3 pm. The at-the-money straddle opened at around 575 points, but managing positions and actually realizing gains was quite tough given the constant swings during the day. Maybe in such high premium environments, it might be worth testing simpler strategies like TBS. Who knows, in phases like these, even simple straddles may actually work. Now, talking about INDIAVIX, after last week's sharp spike, INDIAVIX rose another 14% to close at 22.65. It is now close to the level seen during 2024 general elections results in May-June, when VIX was around 24.6. We often hear that VIX is mean reverting, but the real pain comes when it keeps rising before it actually starts reverting. There's no fixed timeline for when that mean reversion will happen, so let's wait and watch. In hindsight, all backtests look great when VIX eventually cools off, but while we are in the phase where volatility keeps increasing, trading becomes much tougher. Having said that, elevated VIX levels also create some of the best trading opportunities. Provided one can manage risk and survive this phase of rising volatility, position sizing also becomes key at this point of time. Moving on to commodities this week, well, it was very similar to last week, where both equity markets and precious metals fell. Action has shifted to crude oil and natural gas, and in terms of numbers, crude oil topped the charts in terms of gains at plus 4.27%. Next is natural gas at plus 2%. Precious metals, gold and silver both are down approximately 1%, and copper has been flat this week. Rupee has also hit a new low of 92.4. That too has an effect on everything we import as a nation, crude oil and LPG being two of them. For an explainer of sorts on what crude is and how is it connected to natural gas, how India fits into the story, you may want to watch this daily brief episode. Also, on a related but different note, I will be conducting a Zero the Varsity live course on commodity trading basics today and tomorrow. The link is in the show notes. In summary, week 11 saw the sell-off deepen across the board. Bank Nifty led the fall with nearly 7% down, followed by Sensex at 5.5%, Nifty at 5.3%, and mid-cap Nifty around 4.2%. It also marked Nifty's biggest weekly fall since June 2022, underlining the intensity of the decline this week. Volatility continued to expand with wider daily ranges, sharp intraday swings, and the indexes staying well below key moving averages, with pullbacks repeatedly getting sold into. Sectorally, not a single sector closed in green, showing the broad-based weakness in the markets, while INDIAVIX rose further to 22.65, keeping option premiums elevated. Overall, the structure remains bearish, with rising volatility, weak breadth, and rallies getting sold into. Moving on to what caught my attention this week, I have two interesting recommendations for you. One is a blog post and the other one is a YouTube video. First is a blog post by Peter Garicano on his blog Works in Progress about why Europe doesn't have a Tesla. Maybe there are lessons in there for us as well. Next is a video recommendation. Emmy Award nominated filmmaker Matt Devala had created this video during COVID about dealing and preparing for uncertainties. I think this has a lot to teach us in the current context of the markets as well. As always, links are in the show notes. Now over to what to expect in the coming week. Well, the next week is a full 5-day trading week. There are no major known events lined up for the week ahead. As I said last week, these are tough times. And you know, some people say invest when there is blood on the streets. But what if that blood is your own? Such are the times. Let's brace it. I'm reminded of the song To Everything There Is a Season by Pete Seeger. The best part about seasons is that it changes. There is spring after winters. And with that, we wrap up this week's weekly market metrics. If you find the series useful, don't forget to subscribe to this channel. Until then, stay curious, stay steady, and enjoy your weekend.